Happy Christmas to everyone. Christmas Eve and the New Year, and Merry Christmas to all MMTs tomorrow. And what we're going to do, MMTs, is we're going to show a complete monthly level of the VIX chart, which is referred to as the fear and complacency indicator. What I'm really going to zoom in on is that complacency over here lasted for a period of time. If we can take a look back toward the end of the 2007 era on the VIX, we were so complacent we popped up. But look at the multi-month level in 2007. Then in 2008, it comes down. It puts this bottom in right where we currently are in 2010 at these double bottoms. And then all of a sudden, bam, 2008, big capitulation, big double monthly capitulation. But we stayed complacent prior to that move even happening. Basically, MMTs, when I draw these three trend lines here, and in your SMF platform, you'll get your mathematical equations from there. However, one of the things I want to be clear on is that is 30 right up here at the top. So basically, this is where we just had this 3-month, we had that big spike in correction back here because we did when we had the double month breakout. And that's when we were having corrections over here during this time frame. You can see the monthly time frame is right here. And this was a monthly time frame that started in the month of April. And on the stockmarketfunding.com website, we did the same training over here with the VIX, and then I had a big breakout on 5-1, and we had the capitulation right back up to the top. Then we've rallied year to date, and we brought this monthly VIX fear indicator where people are very complacent. And we're going into January and an earnings season going into 2011. One of the things about this, MMTs, is that we are at historical low levels just as we were over here. Now, the problem moving forward is that the world is different than when we were over here in the world. So we may not stay nearly as complacent for very long. However, when you take a look at where this point right here coming right down through here, which is perfect, you can see we got on the other side. This is the right side of the tape. That's where a breakout occurs. The left side was when you stay below the left side trend line all the time. That's why this last high was very important. And it also comes right down to this double month consolidation breakout. And we're testing these levels, MMTs. So what I want people to understand is that when we were back over here, we stayed complacent for a long, long time in 2007. And then this was that big breakout here. What I really want to show you as well, MMTs, is how does it work for you to understand that back in 1991, we stayed that same complacency as we did over here in years 05, 06, 07 started, and 07 started to lead up. We had a nice market sell-off during this period. Then we pulled back and hit the biggest breakout that markets don't like to see. But you can take a look at how things were acting in 93, 94, 95. Look at how those, and then look at that ascending level right up to the big correction up into 1997. So basically, we were breaking higher and higher here on the monthly level. And there were market corrections that happened when things like this. And here's another market correction that happened. And then we got into the big rallies over here back in 99 when the market couldn't do any wrong. And in 98, we did have a big spike and a big market sell-off. But that thing came right down, and we had big breakouts in the markets back in 98 when this thing started making the lower lows all the way over here. In 2000, though, forget about it. Big breakout here. They pulled it back into 2001, but check it out. Check this out. Back then, they pulled it back here, but then it had a monthly doji reversal in 2002, and we made all-time highs at 45. And we thought that was large because this was a 2001 top, and we came right across here, MMTs. Look, you can see the line right here. We came right back up there and tested that, and there was no fear. It was everything was very complacent, but look at the big breakouts back up to those highs. This is when markets had big corrections. These are when markets had big rally, MMTs. When you came all the way down, markets had big rallies to the upside. But guess what happened in 2002? You had an all-time breakout back to these 2001 highs. That's a 3-month breakout there on the fear indicator, and that's what it was doing then. Now, let's kind of move on over here. And in 2003, unlike those other months, 2004, 2003, we had big rallies, and these fear indicators during that expansion in 05 just stayed at the bottom of this trend line. Look at 05, look at 06 here as we slide across there. Look at the 06 here at the bottoms, and then big breakouts there. But then we got over here in 07 when the markets had some turmoil going on. We were breaking higher here. So, and then we broke really high with the capitulation in the 2008 financial crisis over here. My point being is, when we had rallies, we came down. When we had big market corrections, these went much higher. What I am going to show you now is that this particular date right here, right now, in this particular time, is I'm just going to show you. We're getting very complacent again, and everybody's got it figured out that 2011 is going to be the best year. Well, it's set to be a good year, but we're going in to a very complacent level. We'll be monitoring this on the weekly charts, because once we start one of these moves again, we're going to be buying bear funds to go long. We're going to be using various different ETF trade management scenarios that the SMF platform would allow us to use. This is just a standard chart that I'm showing MMTs. This is not your SMF market maker platform that calculates everything for you, but you will know what that is. So we'll talk about that on shorter time frames off video. I'm just letting you see the bigger picture here outside of that weekly level is that we're at critical areas here that we could have potential market sell-offs. It will show up in the daily and the 60-minute charts on an intraday level. It'll show all the warning signs before the big breakout. We're preparing ourselves now because this is very, 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 everyone is feeling good. It's the time of year to feel good, that's for sure. It's Christmas. Merry Christmas to everyone. However, there is a trade in here, and we're going to be watching this closing out the year, going into January. We're going to keep you updated on 60-minute and daily and intraday movements and how these things build before they actually make their move. I can tell you, though, that the public model is very content at these low levels, and that's when market imbalances, imbalanced trends, meaning that we're at the top of the S&P 500, we're at the top of the comp, NASDAQ 100, and the Dow Jones is all up there. The Dow closed at 11,573, NASDAQ 100 at 2230.27, NASDAQ comp 2665.60, and the S&P 500 up toward the highs at 1256.77, down 2.07. That means that these S&P contracts, when this thing does finally put in a bottom, whenever that is, I didn't say it was right away. I will tell you, though, using the shorter time frames, is that's when the put side, like if I'm looking at a put side of a 1210 put side, I bring up a weekly chart on that put side, and I'm going to take that put side, that indexes, you can make lots of money. And what I'm going to show you people is how deflated these contracts were up here at $60. Hey, 4 weeks ago, they were above 50. That means that the lower that goes, no, and guess what? You're deflated. And this is a S&P January 11, 2010 10 put. It's something we're going to be watching, because when you go from extremely deflated down to very inflated to deflated, extremely inflated to deflated, there's a mathematical imbalance in MMTs, and there's going to be lots of trade MMTs potentially coming up using these index option puts and calls. So if I got the calls at the top and I got the puts at the bottom, and we're going to be doing a couple of sharp videos on that. We're going to go through these scenarios, because I can tell you right now, MMTs, if we do put in the bottoms, then guess what? Guess what, MMTs? These pay a lot of money when the time is right. I have not put a time date, but I can tell you right now that when you take a look at a call option, I'm going to put in that call option on the S&P now. I'm going to put that 1240 call just so you can see that the 1240 call is extremely inflated. I'm sorry, say come down the chimney, Santa Claus. Say come down the chimney, Santa Claus, because it's Christmas and you're inflated. MMTs, remember that 1240 calls extremely at the top side of the market. Now, on the other hand, let's pull up that 1240. Let's pull up a 1240 put, and let's take a look at the put option relative to the call option. MMTs, and I have it in the video. You can see over here the calls were, or the puts were $60, and they've been inflated. Now, check it out. They've come all the way down, and these have gone all the way up. And guess what? As an options market maker, I know that the public's all in, and no one's looking at this side of the market. We're going to be looking at the 1240 call and the 1240 put. We're going to be looking at them relative to the monthly movement there on the VIX when we get corrections. Not only that, MMTs, I'm going to throw a weekly chart of that VIX in here so you can see it from a weekly, and you can see that we're going to be monitoring if we hold this double weekly bottom right over here, MMTs. This is the bottom. Merry Christmas to you. I can tell you what, on a weekly level, we have broken all the way down, and this is just all standard charts. But when I put this weekly level in your SMF platform, you're going to be dialed in as to what I'm talking about. So basically, the calls for the 1240 are extended, MMTs. Here is the weekly volatility relative to the monthly. You can see right here on the weekly, that's the double bottom price action, and this over here is the triple monthly bottom in the year 2110 December that we're closing out, and this becomes final. Then the new year comes, and this is the 2010 story that's been told. And I can tell you right now, they were coming in and buying a little bit up off of that bottom. If we break lower and go more complacent, then the bigger the time frame of the forward-looking pullback will hit that market. And what we're going to be looking at is what the next 15 full trading days is. So we're going to take the last light holiday, New Year's Eve, and we're going to be monitoring so that we can buy short bull funds, go long bear funds, go buy index put options, different instruments that relate to these corrections when they get here. And we're not too far away. And this is the Christmas special on the volatility index here and now.